Welcome to Seven Bulls. We break down finance so that anyone can understand. Roll the intro.
Hello, fellow investors. Welcome to Seven Bulls. Today we're getting into interest rates. Now, I know what you're thinking. Interest rates? That's boring. But trust me, this is anything but. It impacts your everyday life, from your mortgage payments to the returns on your investments. Before we move on, if you find value in the video, make sure to like and share. Also, watch until the end and leave a comment. This helps us with the algorithm. We really appreciate it. Thank you. Now let's get to it. Okay, let's break it down. What exactly are interest rates? In the simplest terms, it's the cost of borrowing money. When you take out a loan for a house, a car, or even just using your credit card, you pay interest on the amount you borrow. Businesses do the same, borrowing money to fund their operations and fuel their growth. Now, enter the Federal Reserve, also known as the Fed. They're the central bank of the United States, and they have a huge influence on interest rates. Their main job is to keep the economy running smoothly, and they do this by adjusting interest rates. When the economy is overheating and inflation is raging, the Fed raises interest rates to cool things down. This makes borrowing expensive, encouraging people and businesses to spend less, which helps to tame inflation. For the past couple of years, we've been in a rising interest rate environment. The Fed has been steadily hiking rates throughout 2024 and into 2025 to combat the highest inflation we've seen in decades. But here's where things get interesting. They've signaled that they might tap the brakes on these rate hikes or even pause them altogether in the near future. Why the potential shift? Well, inflation seems to be gradually easing, but it's still a bit higher than they'd like. Plus, there's growing concern about a potential recession looming on the horizon. Now, you might be wondering, why are interest rates such a big deal? Well, they have a ripple effect throughout the entire economy. Think back to the 2008 financial crisis. One of the contributing factors was the era of cheap money. Interest rates were kept artificially low for a prolonged period. This led to excessive borrowing and risky lending practices, ultimately contributing to the housing bubble and the subsequent market crash. The Fed learned a valuable lesson from that crisis. They realized that keeping interest rates too low for too long can create imbalances in the economy and fuel speculative bubbles. That's why they've been more proactive in recent years, raising rates to prevent a repeat of 2008. So, how does all this impact your investment portfolio? Historically, rising interest rates tend to put downward pressure on the stock market. When borrowing becomes more expensive, companies face higher costs, which can eat into their profits. Plus, higher interest rates make bonds more appealing to investors as they offer juicier returns. This can lead to a shift of money from the stock market to the bond market. But hold on, before you hit the panic button and sell all your stocks, remember this. Not all sectors react the same way to rising rates. Some actually thrive in this environment. Think of financials, especially banks. They benefit from lending at higher rates, which boosts their profits. Energy companies also tend to do well during periods of inflation. On the other hand, sectors like technology and real estate, which are sensitive to borrowing costs, might face some headwinds. Now, for the million-dollar question, what should you, as an investor, do? Here's the game plan. First and foremost, don't freak out. Investing is a long game, not a get-rich-quick scheme. Making impulsive decisions based on short-term market jitters is rarely a winning strategy. Stay informed. Keep your finger on the pulse of the economy. Pay attention to the Fed's announcements, economic indicators like inflation and GDP growth, and what the experts are saying. There are tons of resources available online in financial publications and even on YouTube channels. Some like to diversify their portfolios, not put all their eggs in one basket. Spreading your investments across different sectors and asset classes may reduce your risk and increase your chances of success. Consider your time horizon. If you're investing for the long haul, like retirement, short term market fluctuations shouldn't keep you up at night. The market has a remarkable history of bouncing back from downturns. If you're feeling lost or overwhelmed, don't hesitate to seek professional advice. A financial advisor can be your guide, helping you navigate these uncertain times and develop a personalized investment plan that aligns with your goals and risk tolerance. And that's that. If you enjoyed this video, don't forget to smash that like button, subscribe to the channel, and share. Remember to keep up with your financial education. We're the only ones in charge of our futures. Be safe.
We grew